This is the Definitely Uncertain podcast, brought to you by Gold Rock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. Welcome, everybody, to the Definitely Uncertain podcast. My name is Darren Rockman, and I am a partner at Gold Rock Capital, the 20-year-old multifamily office servicing high net worth families around the world. And today on the podcast, Daniel Mendoza joins us. Hi, Daniel.
Hi, Darren.
Hi. Daniel is coming to us from London. He is the founder of Ereira Mendoza, which he put together in 1990, which is a niche brokerage and booking practice acting for private and institutional capital across UK commercial property, and is an expert in the world of UK real estate, and as such has been for over 10 years a regular contributor to Property Week. And amongst his other things that he does, he's also the chair of the Anne Frank Trust. So what is the Anne Frank Trust, just to start with?
The Anne Frank Trust is a UK-wide educational charity that helps and develops and informs young people on understanding all forms of prejudice and discrimination, and gives them tools how to deal with it, and also helps them develop as individuals, self-esteem, engaging with communities, that sort of stuff. So it's something that is massively important to me, and also I'd say to everyone out there, which is our ability to get along with each other regardless of our differences.
Wow, that's fantastic. Well done, and it's great to see people doing good things out there. But we're going to switch from that to the real estate sector, and particularly commercial real estate. Let's just talk a little bit about what's happening in the UK. So I think at this point in time, it's true to say there is still a lot of uncertainty in the market, and we're seeing probably different polar opposites in terms of behavior. On one side, you have a look at some of the listed property stocks like British Land, trading still 25% below where they were back in January, February, and indicating to the market that there is trouble or valuations are impeded. And on the other hand, we hear that rents are being paid on time, and things on that side seem to be okay. So help us dispel some of this confusion and understand what's really going on at the coalface.
I think you picked on a very interesting kind of, as you say, polarization between the two elements, which is how the public markets are reacting. And even if you take down to the broader footing, look at FTSE, it's gone down 30%, it's gone back up 25%, it's down another 15%, it's bouncing back up. Whereas obviously the property market and what we're seeing, on a granular basis, rent collections is telling a different story. The reality of it is right now, nobody really knows where it's going to settle, because nobody knows what the ultimate impact of COVID is going to have on occupational tenants, be that their ability to pay their rent, depending which sector they're in, or what may happen in the market occupationally as we move forward.
Right. So, when you look under the surface of all that and underneath the uncertainty, what's actually happening? Are you seeing a change in the way that companies are approaching real estate? There's been this talk about work from home. Obviously it's been enforced upon us. But how are property managers within corporates thinking about 2021 and beyond?
Okay, I think that as far as, let's maybe split between the occupational side and the investment side, which I'm imagining obviously both those things are relevant, but can be more of interest to the guys who are going to be watching this. Occupationally, what we're seeing is a narrative emerging whereby, yes, we think that there will be more people working from home. That's going to happen for sure. How does that feed through to the occupational requirement? Does that mean that we may need 20% less foot space? Or when you factor in distancing, will those two things neutral each other out and you actually need the same foot space, but you just spread it out a little bit further? We don't know is the answer, whatever other professionals might say. But what we are seeing, and it's very interesting, it's anecdotally, for example, Google, they've got a 1 million square foot HQ by King's Cross. They told all their staff, a good 2-3 months ago now, look, we don't expect you to be coming back in till at least next year, and even then we don't know when.
Right.
1 million square feet, new HQ. And yet they are just acquiring a further 70,000 square feet at the moment near their HQ to allow for what? So the other poll that I read, I think, is PwC, one of the large accountants, did a poll that was featured in the Sunday Times, saying that they expect, and this is the key thing occupationally, collaboration and teamwork, is really what people are missing from not being in the office. Do you expect us to go back to where we were? And the response to that from Sunday Business Times readers were, 77% expected us to go back. But if I knew the answer, I wouldn't be sitting here now.
You'd be out buying every building you could in London.
Yeah. So, they're selling. Yeah. So that's an unknown. As far as the investor market is concerned, we have seen really strong appetite. So I think when you look to what's going to be happening occupationally, and say, well, actually the occupation in a funny kind of way is more the symptom of what's going on, not the cause. And the cause from an investment point of view, and what we're seeing is looking at property now as part of a global diversified asset, rather than being singularly comparing where we are now compared to what the market has been. So we're seeing a lot of capital, both UK and global capital, saying, we can put our money in the bank and earn nothing or negative in some places. Look at equities, look at volatility, we think it's fully priced. Look at bonds, very little return. Property, we can effectively buy bond-type assets let to government or other very strong tenants. Question mark over what is a strong tenant at the moment.
Yes.
With a 5 or 10 year term, where we're getting returns of maybe anywhere between 4% and 7.5%, 8%, depending where you are on that risk spectrum, and we've got a hard asset at the end of it.
Yeah.
So from a relative point of view, sorry.
Yeah, no, that on a relative point of view, it's sort of attractive. I think we're seeing that in other sectors as well.
It looks remarkably attractive. Yet you've got this other element going on, which is, well, how is that going to feed through to the occupational market?
Right.
Which is a bit we don't know.
Yeah. So are you seeing transactions in the market, and you seeing transaction volumes change and pricing change in things that are moving buyer to seller or seller to buyer?
What we're seeing is volumes have shifted dramatically. Certainly last quarter we were something like 80% down in volumes, but the product that is trading is still getting very strong pricing. We're not seeing a huge amount of shift in pricing at the moment.
Right. And is that true across the UK, or is that really central London? When you look out to some of the regional centres or beyond, are you seeing that same pricing dynamic play out?
It's driven by 2 or 3 different elements. First element is what we call the bond type yield covenant purchases, where purchasers are looking to buy a guaranteed covenant strength for a minimum fixed period of time, and whether that is in whichever sector or whichever location, of course, relatively comes in there, that they're happy to look at that. The other element is very much sector specific. So there is the industrial sector at the moment, for obvious reasons. The demand for distribution, last mile logistics, Amazon is incredibly strong. And we've seen ridiculous growth in that area. I personally think that it's been a little bit blanketed in the sense that everything industrial must be gold. And if you look at what may happen with the supply chain to everyone supplying those retailers, those hospitality businesses, where there must be some impact, I think a little bit of a health warning needs to be put on that. But we're also seeing interest in the retail sector. As we know, that was a trend that was, impacting values greatly, However, there is value at the moment in some retail warehousing, where certain parties feel that the value of those assets will underpin from an industrial value perspective. So sector-wise, it's important. London, just because of what it is, where it is always going to be sought after.
And the Brexit issues, are they impacting, or has that sort of now been fully priced into the market and nobody's too worried?
Brexit has been priced into the market. Nobody really seems that worried. Again, whether or not that's justified, we'll only better tell in a few months. Yeah, in a few months' time. But the consensus from, I'd say, a lot of the very seasoned professionals in our market has been that has been priced in, and ultimately the desire to be in London, whether that's from a general business servicing point of view, transparency, that is going to remain.
Okay. Now let's just switch to the funding side, and let's just talk a little bit about banks and their approach right now to the property sector. Are you seeing banks going through their real estate books and saying, or starting to identify some of the problem patches? Are they doing anything about it today? And how do you see things play out, say, over the next 12 months?
Okay. Anecdotally, at the moment, because of interest rates being as low as they are, albeit I would say numerous borrowers would be in default of their LTV linked to covenant values, covenants. The banks at the moment don't want to become the biggest property owners in the UK. As long as their debts are being serviced. So what they are doing is they're getting in contact with those parties that they feel slightly concerned about, getting ready to take possession if needs be. But as long as the debt's being serviced, they're okay. And obviously the lenders that they have a lot of faith in, experienced borrowers have a lot of faith in, they will be slightly more stand backish, but they are looking at those covenants. They are putting those parties on notice, so they're able to take action if they need to. But at the moment, they really don't want to, unless they absolutely have to.
Right.
So what we are, sorry.
Go on.
Yeah, what we are seeing, we obviously, I spend quite a lot of time talking to banks and receivers. We want to kind of see what's coming down the track. And the receivers are more busy than they've been probably back to 2008. So that's definitely happening. But they aren't yet getting much stock coming through. But it's there, it's coming in the pipeline.
2021?
So we do expect more stuff to come through. Yeah, 2021. Saying that the more this time has gone on, I originally thought we'd start to see maybe some value and some opportunity towards the end of this year. That's not going to be happening. Not to say that there aren't deals going on, but I expect as we're now looking maybe more towards, certainly Q1, probably Q2, Q3 next year, by the time it ripples through.
Right. And where do you see there's being pockets of distress building up in the market? Is that happening? Clearly it's happening in retail. Are you seeing it in other places as well?
Yeah, of course, again, we're seeing it in those hospitality sectors. So we're seeing it in the leisure market, hotel market. That's obviously where the real pain is at the moment. And it's very difficult. It's a bit like, going on the roulette wheel. When's the vaccine going to arrive? At what stage do you want to jump in if that's your thing? And see where the market, see when the market comes back. So actually, that's not really necessarily a property play. Sure, go back, understand the asset, know what the values are, believe what they're going to come back to. But you're really deciding, how quick is that going to happen? Again, we could all see what happened, in the equities market when the Pfizer vaccine was announced. And that's what you're looking at as far as that's concerned. I think the one area that we're certainly starting to see now and will continue to move forward is a squeeze in liquidity. Mm-hmm. So as that starts to wash through, what you'll find is that's when the banks will start to squeeze a little bit harder, and you may start to see a bit more sort of opportunity, distress emerging. But we're not seeing it in any sort of meaningful way at the moment.
Right. What do you see as attractive to investors right now? You mentioned, I think, two things. You mentioned sort of certainty, sort of long leases. You also mentioned the retail warehouse sector. So what do you see is going through investors' minds as they're thinking about deploying capital?
Yeah, if I had to split it, and again, I'm kind of guessing who the audience here might be, the fundamental is long and strong. So we're seeing what would be considered undoubted, use that in inverted commas, tenants, security of income, with a lease of at least 5 years plus, possibly up to 20 years. Obviously, the longer the lease, the sharper the yield. And I can give you an example, in the last month of 2 assets that have traded, right, where I'd say both very, very strong tenants. One had a lease for 9 years, the other had a lease for 13 years. So there's your kind of bond element. Where one, and lot sizes wise, the one with 13 years was around £10 million. It was marketed at a cap rate of 6.5%, and that's actually traded at 5.3%. And the other asset, which was about £5 or £6 million, was marketed at a 5.75% cap rate and traded at 4.3% cap rate. And that's not to say, from a marketing point of view, that these were put out particularly soft prices to get the interest, although that does happen. I say the vendors are market. Well, I was surprised how sharp that pricing went, but it shows that there's that real desire now just to want to get your capital working for you
and those aren't institutional size lots. You're talking about high net worth or small fund type acquisition lot sizes. So it's not only the institutions, it would seem, that are trying to find a way of replacing their bond portfolios. It's individual investors.
But very much so. In fact, with one of those assets, again, surprisingly, it was an institution who acquired it. Fighting against private capital.
Right. Interesting. Okay. And maybe just to sort of finish off, your view on the retail market in the UK, high street, shopping centre and retail warehouse.
If you want Mrs. Mendoza's view, it's quite busy at the moment. I have
hopefully she's buying you some nice clothes, though.
Yeah. What are you trying to say? No, I think as far as the market's concerned, as we touched on earlier, there were very strong trends coming through already. Of course, the impact of internet shopping on the retail market. So there is the strong retail centres are still very strong, notwithstanding this COVID blip where people can't get to them. But there is, and actually it's very interesting doing this, because I think fundamentally this goes to the purpose of property, which is property is here to serve as a function of human behaviour, whether that's where we're working, where we're playing, where we're shopping, whatever it may be.
Right.
So what isn't changed, or it hasn't changed so far, is that desire for people want to interact. They want to touch and feel. I think that's going to continue to diminish. I can certainly see it with my own kids as far as their willingness and happiness to buy without going onto the high street. So that trend that we've seen will continue to evolve. And the market is split between prime shopping centres, where unquestionably there's an impact on rent and rental values. And again, we do not know where that is going to bottom out and to become sustainable. You're looking at out-of-town retail parks, which we've touched on, and which there's definitely investor, there's more appetite investor for that. And the other element that's coming into play now are more so turnover-related rents, which is the concept of something that was very established already within some of the retail outlets, but on the high street didn't exist at all. So there's a real gap of knowledge at the moment as to how that is going to filter through and the impact it's going to have on value. And there's also a shift in dynamic from that really stringent landlord-tenant relationship down to, okay, actually you're kind of in partnership with them on that particular site, wherever it may be. So it's going to be interesting to see. But what we're seeing investor-wise at the moment is confidence in that sort of retail warehousing market, depending on the micro location, and also to a degree having relationships with the tenants previously to be able to pick up the phone and say, "Hey guys, how are you trading in that one?
Yep.
Where do you think it's at?"
Are you going to stick around?
Yeah, I don't think it's going to go anywhere, but as everything in life, it's going to evolve.
Right. Okay. And for the high net worth investor who's now focusing on opportunities into next year, where would you be directing people's attention, or what hints could you give them as they're approaching this market? With a sort of 5 to 10 year outlook.
Okay.
I know that's hard.
Look, it's for us fundamentally, and I'd say this to your audience, whoever they choose to get their advice from, if they're looking in this market, is number one, make sure that you can trust that advice. And certainly from our point of view, the key element is to really understand what's driving that requirement. So is it income? Is it long-term capital growth? What's the structuring involved?
Right.
So we've already touched on undoubted tenants, with a long lease. That seems to be the real desire, because if you're going to be buying buildings that maybe have got some asset management or some refurbishment involved, unless you've got the structure or the setup, that's going to be something that's going to be fairly difficult to get your head around. So the other thing we're talking to clients about is, these guys, they're genuinely, they're sophisticated, they're entrepreneurial, and they've made money in the sector, be it property or otherwise. So what are you seeing in the world? What are you experiencing? Which sectors do you fundamentally believe in and think you're going to see growth? Because you can then bring your expertise and knowledge to the market, saying, we back these tenants. So whether you look at sectors such as, the care sector, people are living longer. There's definitely growth in that space, retirement living.
Right.
You look at the UK and you look at, biomedicine, and you look at technology. Again, there's a lot of growth in that sector, UK service industry. And then you look at those evergreens, which are people going to continue to buy food? Are people, what are the elements they're going to continue to do? And so you as the investor, your own insight, and bring that to bear on whoever it is you want to advise you in your acquisitions.
Okay.
So,
very good. Well, Daniel, that was really helpful. Thank you very much for giving us that great overview of what's happening in the UK property market. We really do appreciate it. And it's been a real pleasure having you on the show.
Well, thank you also genuinely for inviting me. So I've seen that the roster of previous speakers, it's an honour to have been invited. So, and I continue to wish everyone health and safety as well.
Yes. Well, thank you. And to you and all of yours over there in London. And thank you, everybody, for watching the Definitely Uncertain podcast. You can subscribe on YouTube or using your podcast player. Thank you to Andrea Herman, our producer, and to Idor Schlesinger, our editor. And we will see you next time.